Okay, so welcome to everyone who's joined. We are looking pretty good on numbers, so we'll probably just dive straight into things. I'm going to just start by giving a brief introduction to those on the panel. So my name's Phil Day. I'm a Senior Business Development Manager with Iris. My colleague Michael France is also on the call. He's Associate Product Manager for Iris, and Andy Roberts, who some of you may be familiar with, is Head of Specialist Protection at Zurich. So we are today going to run through some examples, and during the session we're going to look at the impact the political interventions such as freezing of nil rate bans, restricting relief, and of course how pensions are now going to be brought into scope from April 2027. So we're going to work through some real world examples. We're also going to use some detailed modeling using X-Tools, which is a feature within Xplan, the Iris CRM. So that modeling will help us quantify the IHT liability. And then, of course, we'll look at how protection is the key solution to the problem. And that brings us on to having Andy present. So Andy, as I said, is Head of Specialist Protection at Zurich. I think, in my opinion, Zurich are one of the providers that are leading the way in terms of specialist protection, IHT planning, and what Andy doesn't know isn't worth knowing. So over to you, Andy, and you can give us some market context.
Thanks, Phil. No pressure. Afternoon, everyone. I'm delighted to be here. So, yeah, I wanted to just initially give a little bit of market context. I would expect the majority of people on the call are probably going to be familiar with most of this, but to sort of set the scene, inheritance tax is an ever-tightening net. The methods by which people can mitigate against IHT liability or indeed avoid it altogether are being closed more and more over time, and notwithstanding the continuous freezing of the nil rate bans as well, which as it stands have been frozen since 2008 to 9 and will be at least until 2031 as it stands. So the fiscal drag is bringing more and more people into the net naturally, and then we've got the various reforms that have been brought in over the last year and a bit, and indeed will continue to do so next year as well, that are meaning that the popular phrase that some people will be familiar with about IHT being a voluntary levy, that phrase is 40 years old now. It was the Chancellor of the time, Roy Jenkins, that coined that, the inference being that with careful planning, IHT can be avoided. But as time goes on, that is not necessarily the case. And what that graph is showing on the left-hand side there is for the OBR's forecasts, and what they generally forecast IHT receipts 5 years into the future. So what that's showing there is that their last three forecasts, so dating back prior to the autumn 2024 budget, when the IHT reforms were announced, that's the blue line, and then the green line is shortly after that budget. And then the purple line is the most recent one, so from March 2026. And you can see, it's an exponential increase in the forecasts up to the best part of 15 billion as it stands. Let's have a quick look at the reforms that have been brought in. I mean, one of them already came in, which was the scrapping of the non-dom regime last year. So 6th of April 2025, replaced with the residency regime. Then the tax year just gone, the new tax year that we're a couple of months into now, was the reform on agricultural and business property relief. So agricultural relief was previously 100% relief on certain agricultural assets, so land, for example, after typically 2 years. So assuming the land was owned and occupied by the owner themselves, then after 2 years, that those assets would be 100% relievable from IHT. And that quote on the right-hand side, attributable to Jeremy Clarkson, the government doesn't get any of my money when I die. People tend to associate that now and assume he said that on the Clarkson's Farm program. He actually didn't. That dates back to 2010, I think it was, when he first bought the farm, and was very clear with his rationale as to why he had initially done it. Clearly, that they have eventually got him in that sense, and now they will, because since 6th of April of this year, the 100% relief is restricted to the first 2.5 million of combined agricultural and business assets, with only 50% relief thereafter. It is, however, per person. So a couple owning a farm together would have a £5 million allowance, and that allowance is transferable between spouses and civil partners in the same way that other assets are freely transferable, and nil rate bans can be claimed between spouses as well. And then the story for business property relief is very similar. So previously, 100% relief was available after qualifying business assets had been held for 2 years by either the donor, if they were giving them during their lifetime, or if they bequeathed them upon death. So that is typically shares in unquoted companies, a private business, or an interest in a business, or indeed shares listed on the alternative investment market, which are quoted but not on a recognised stock exchange. But again, 6th of April, the situation is the same. When combined with agricultural assets, 100% relief is restricted to 2.5 million per person. And specifically for AIM shares, they will only receive 50% relief regardless of the value. So they're not included in the £2.5 million allowance. They will only get 50% relief one way or the other. And then we've got, I think, what is arguably the biggest one, or certainly in terms of the number of people impacted, and the impact upon the everyday person, if you like. Bearing in mind that the business and agricultural relief, a couple can have £5 million worth between them before the 100% relief is lost, and therefore it's restricted really to the high net worth individuals, whereas inherited pensions is in theory bringing everybody in scope. It's not to say everybody will be impacted, those with smaller pots, but the majority of the working population are going to have pensions, or indeed retired population, and therefore this has really brought I think inheritance tax into the mainstream, in that with some exclusion, so death in service benefits and dependents pensions, for example, the vast majority of pensions, including defined contribution schemes that were previously excluded, are going to be brought into scope, and indeed they'll count towards the residence nil rate band tapering threshold as well. So over £2 million worth of assets, the residence nil rate band starts tapering down by £1 for every £2 over that threshold. A big pension pot could push somebody into that over that £2 million where they weren't before. So the government estimated at the time they proposed this in October 2024 that 49,000 estates are going to have either a new or an increased need for life cover. But of course, that's that'll be at the point 6th of April next year. But in future, many younger people who might not be one of those people impacted immediately next year, in years to come, may well be, and therefore the scope, the impact of that is particularly high. So where protection comes into this conversation is largely around, in my opinion, that certainty and liquidity. They are the two main reasons for putting protection in place against an IHT liability. And the reason being is the catch-22 situation, which I think is very well known, that inheritance tax is due within 6 months, but the personal representatives of the deceased who are responsible for paying the IHT can't access most of the assets in order to pay the IHT in the first place. They won't be able to get those assets, the majority at least, until the tax is paid and the probate is granted. Excuse me. So hence the catch-22 situation. And that is where protection comes into its own, because it can expedite the money in order to pay the IHT bill in a timely manner. So the graph on the right-hand side here is from the Office of National Statistics, and showing what typical household wealth, the distribution of typical household wealth. So I'm mindful, by the way, in case anyone's very eagle-eyed and noted that adds up to 99%. That wasn't my error with the chart. It does on the ONS website for some reason only add up to 99%. But nevertheless, 40% of a typical household's wealth is held in property. Now that's not going to be accessed but prior to probate. So that's a big chunk of an estate that can't be accessed. You've then got physical assets, 10%, again, won't be accessible prior to probate. Only 14% of a typical household wealth is held in financial assets, so cash, for example, which may be accessible prior to probate to pay the IHT bill, not necessarily, but possibly. And then you've got 35% is held in pension assets, which can't currently be accessed to pay the IHT. They may be able to from April 2027, but only to pay the IHT arising on the pension itself. The box below that, apologies, the box below that is meant to say something different. I think that's a duplicate of a slide a couple ago. But what that's meant to talk about is really the challenge that the personal representatives are going to have to pay the IHT bill. Where are they getting the money from? On the expectation that 14% at most of financial assets that could potentially be accessible to pay the IHT. If the IHT bill is in excess of that, where is the balance coming from? Are they going to be willing and indeed able to use their own savings to pay for it? If not, where are they going to borrow it from a bank? I mean, there are probate bridging loans which can be available, but again, they can be complex and expensive, and therefore aren't necessarily the option. Whereas a life insurance policy held in trust expedites the funds for the personal reps to be able to settle the tax bill quickly, because if the IHT is not paid within 6 months, then interest is going to be charged. Late payment interest will be charged, which is at a rate of the Bank of England base rate plus 4%, which at this moment in time is 7.75% compounding interest. So that once you get over that 6 months, if the interest isn't paid, the IHT isn't paid, that interest is going to start rolling up and cause liquidity issues. And that for me is where life insurance comes into its own. We'll correct that, by the way, before we send the slides round. Afterwards, we'll get that slide saying what it should do at the bottom there. So just have a look at a couple of case studies. We've got a couple here, recently retired. They've got an estate worth 1.6 mil, which, when you take off the nil rate bands, leaves an IHT liability of £240,000. And putting it simply, the most suitable product that will be for them will depend on what their future plans and their financial goals and objectives are. So I mean, the first one I've called here permanent IHT liability. I refer to really for an IHT liability that is going to exist until death, whenever that might happen, because the clients don't expect to be able to erode their IHT liability by a certain point, which they, with gifting, with investments into IHT friendly schemes, may be possible for some people to erode their liability by a certain age. Where that is not possible, then the liability is permanent, and as such, the solution there is most likely to be a whole of life policy. And for a couple, per this scenario, would be on a joint life second death basis to make sure that the product pays out when the liability arises. And the example there is £240,000 worth of whole of life would be £329 per month. On the flip side to that, we've got what I'd refer to as a temporary IHT liability, which on the residual estate would be the scenario I've just said, where they do expect that by a certain age, they would be able to gift or invest away their IHT liability, and therefore they don't necessarily need a whole of life policy, which of course, a whole of life policy is much more expensive than a term policy, hopefully for an obvious reason that it will pay out at whatever age the client lives. Whereas a term policy whereas a term policy has to pay out within a certain time frame. So in that same scenario, if we take it to the highest age that's possible for a term policy, which is age 90, then that same £240,000 worth of cover is £114 a month. Much more or much cheaper, but the important thing is to have the right product, not necessarily the cheapest product. So only in the scenario where the clients expect to be able to get rid of that IHT liability would we expect that to be the case. Or indeed, it could be a combination of both. You know, you could have a split, so a certain amount of whole of life cover and a certain amount of term cover to cover that expected liability that will be eroded by a certain point. For the time being, I'll be quiet for the time being and hand over to Phil.
Okay, so I should have said at the start, if there's any questions that people have, feel free to fire away in the Q&A box. We'll pick them up at the end. The next slides, or we're going to move from slides to actually attempt a bit of a live demo. So Michael is going to take the reins of X-Tours, and we're going to show you, I suppose, looking at case studies in a bit more detail. So when it comes to IHT, the mistake sort of many advisors and clients fall into is that they treat the planning as a one-off exercise, often at the time where the client retires, and they overlook the fact that the estate value will almost certainly change over time, specifically next year when the pensions trap is going to come into effect. And will be the most significant impact we've seen in recent years on IHT. So with this particular case study, we're going to model a couple who've not yet reached retirement. So their children are grown up, they've just paid off their mortgage on their property, which is valued just around about the 1 million mark. They each have 300k in pensions and 60k in liquid assets. So from today up until the 5th of April 2027, they don't have too much to worry about. They have a small IHT liability of 40k. Probably not going to be of too much concern to them. It would be nice to have the protection policy so that they're not dipping into the estate to cover that 40k. It's not essential. There's enough liquid cash in the estate to cover it. So all seems fine until we hit next year. So literally overnight, we are going to see this couple go from an IHT liability of 40k through to, or increase to 280k when their pensions come into the equation. So with the apportioned element of the liability associated with the pension, which is 98,824, this can be deducted from the inherited pensions if they choose. So it does mean that the estate needs to find another 181,176 within 6 months of death to get through probate, as Andy mentioned. And in an ideal world, this is paid in full, but the property element can be spread over 10 years, as you're probably aware. So in this instance, you've got somewhere around about 27k needed to release probate, and there's sufficient cash to cover this. They'll still need to find a further 17,000 each year for the subsequent 9 years, or 154 when their property is sold. It probably makes more sense to cover that with protection, though. It simplifies the process. You're using insurance money to cover this 280,000 liability as opposed to the estate losing it. But the other consideration is that this is a snapshot in time. So it's not going to stay like that. And that is where we look at using modeling tools like X-Tours that Michael's going to show very soon. So this couple, they're still working. They will still be contributing to their pensions adding funds into their ISAs as they prepare for retirement. So Michael, if you want to share your screen.
Yep.
And we will take a look at what X-Tools or what some modeling can show us. So hopefully everyone can see that. What we've got here is a bar chart that represents the value of their estate. And you can see in the very first bar, the pension value is in orange. And that's going to continue to grow whilst they're still working for the next few years. They then retire in 5 years' time, when Jane is 62, and the pension moves to drawdown. So that's now shown in subsequent years in blue. They've taken their PCLS, which increases their cash holdings, and that's visible on the chart as well. But this will reduce as they go through retirement. The one thing that doesn't reduce is the property value. So the property continues to grow in value. This becomes by far and away the most significant asset as the other assets are reducing, to the point where somewhere around their mid-80s, they've virtually no liquidity to pay any IHT. The property is accounting for the majority of their portfolio. Moving on, and Michael's going to jump into one of the other tools, or the other parts of X-Tools rather. And on this graph, and it's just loading, we can see, there we go, we can see the projection of the IHT liability into the future. So in year one, that orange bar is very, very low, because that's where we're at the moment, 40K liability, significant jump in year two. It then continues to grow fairly steeply as over the next few years, as they've got more disposable income and increasing savings and in pensions, and it levels off around about their retirement age for a further 5 or 6 years at about 450K. But the liability doesn't stop there. It continues to grow, eventually levels off at around about 700K. So what the next thing that Michael's going to show will just demonstrate the reduction in the liquid assets and the gap between the liquid assets that they have and the actual liability they've got to pay. I think that's quite a powerful way of demonstrating to a client that, you know, it only gets worse as you go through retirement, or certainly more difficult. We look at, I always think it's interesting to look at what the split of an estate is. So in this example, there are 4 children. So we can see in this example, currently the children inherit all but 2.35%, which goes to the taxman. If we fast forward to April, when the pensions come into the equation, and the taxman's the winner now, his share jumps to nearly 18%, almost as much as each of the children are receiving. So now you've got the consideration that you've got 5 beneficiaries of the estate, all roughly inheriting or receiving, in the taxman's situation, equal amounts. And if we go forward just a few years later, so 5 years down the line, the taxman now is the main recipient. So he's now receiving 21%, exceeding everything that the children receive. And as you go through retirement, Michael will probably show you in a moment, just sort of further down the line, where the taxman's portion exceeds 25%. So personally, this would, if I was being advised on IHT, this would be the most compelling reason to act and do something to reduce or eliminate that liability. You know, does anyone really want the taxman to be the largest recipient of the estate? Is it a little bit too blunt to ask the client if they value the taxman more than they value their children? But ultimately, you know, when we've reached this point, that is what it looks like from a financial perspective, at least. So the question is when to act and at what level. So we've seen the liability will jump from overnight to 280k, then grow to further 450k, then level off and then rise again. So protection, if we're focusing on that as the key element to reducing or eliminating IHT, you can act on that now with your clients. So the cost of delaying and setting up the policy is obviously that it becomes more expensive. Worst case, or an even worse case scenario, is that they've got medical conditions that means that they cannot get cover, or it becomes significantly more expensive. So I'm now going to share my screen, and I'm going to run a few quotes. So if I just make sure I'm sharing the correct screen and look at the exchange. So if somebody could just, Michael or Andy, just confirm I have shared the right screen and you've got the exchange. Yep, I'll take that as a yes. So when we look at the exchange, I've already loaded the client's details. We've got
Phil, I think you're sharing your Elite Studio, not your exchange.
Okay, bear with me. Sorry, there was always going to be some kind of technical difficulty, wasn't there? So I'm going to try again, and there we go. That should be the exchange. Am I right?
Alex, better.
Please say yes.
All right now.
Perfect. Okay, so the exchange, some of you will be familiar with. It's Iris Protection Sourcing System. I've preloaded Bill and Jane's details with their age, occupation, height and weight for BMI. And I've preloaded the quote to do a whole of life quote for £280,000 on a second death basis and quoting level. So you can see on the right hand side, these are the providers that will be able to quote a whole of life policy. As Andy's on the call, I'm not going to show any of his competitors. I will just show the details for Zurich. So if I get that quote for 280,000, obviously, if you were looking at the whole of the market, you get the results for the whole of the market. But for Zurich, to cover this liability when it increases next year to 280,000, it's going to cost about £318. Now, the question is that going to be sufficient? Well, obviously, we know from the modelling that it's going to increase in 5 years' time. So what would you do as an advisor? Would you then look to top that up in 5 years' time? So if I run another quote and make them 5 years older, so we'll just change the date of birth just to show what that looks like. Again, just show Zurich and change the sum assured for the increased amount, so a further 170,000 to run alongside the 280,000, bringing it up to the total of 450. That's an additional £250 a month now because they're 5 years older. But obviously, I've mentioned that you run the risk that they can't get insurance or it's loaded. So would the solution, rather than doing the combined or doing two separate policies, doing 450 from day one? So let's just re-quote on that. I'll put them back to their correct dates of birth as of today. And for me, it makes more sense looking at future-proofing the IHT or the whole of life policy. Also, the combined costs were, is it 318? So let's call it 320 and another 250. It's actually cheaper to effect a £450,000 policy when they're younger than to wait and increase it. But we've also got the scenario that this is going to increase over time. It's going to eventually peak at 700,000. So would it make sense to include some indexation? So 450,000, and we can make that increasing cover. So the beauty of indexation is obviously you've got the increase of RPI each year, which in theory may not go exactly in line with the estate, but it will certainly be there or thereabouts. But again, comparing the quotes against modelling would allow you to kind of look at the indexation option. The other thing to consider with indexation is that it's not automatic, or it's not necessarily going to happen every year. The client can opt out. So if you use indexation to increase until the cover hits 700,000, then you can actually decline the indexation, and then it will level at 700,000. So for me, that's the ultimate solution of quoting for whole of life, to be able to get 700,000, future-proof it completely. You could consider things like doing term to age 90, which Andy mentioned. You could take a hybrid approach. And obviously the hybrid approach means that you can reduce costs. You could do, 450,000 or 400,000 of it on a whole of life basis, and the rest term to age 90. So there's many different variations that you can quote for your clients. So I'm going to close that. And am I still sharing, or have I stopped sharing now?
You stop sharing.
Okay, perfect. I'm getting used to the system at long last. So yeah, that's I suppose a good example of how we can use protection to be able to protect against that liability. I appreciate there's more than one way to skin a cat. There's other effective planning methods to use to reduce IHT, but protection, well, it remains one of the most effective and simplest ways to take steps to eliminate an IHT. So was there something else? What's next? Sorry.
Yep, I know. While Phil was doing his presentation, one of the things you can also do in X-Tools is model back the insurance as part of your cash flow modeling. So what I've done is I've entered the whole of life cover that Phil quoted on at the end, and I put the premium in and the life cover. But I think when I was just practicing the modeling while they're out, an important thing came to my notice, which is obviously we must always remember to put our protection plans into trust. So if you look, I'd put the owner as joint instead of written in trust. And when I went to my IHT liability, what I'd actually done is increase my IHT liability by adding the whole of life outside of the trust. And again, you can see that in there, but I think that's the wrong picture. But I think it really highlights again the importance of why trusts are important. You can see even in year one now, because we've not put the protection in trust, we're up to 320,000 IHT, going up to 696,000, and peaking at 1 million. So, we must put those in trusts, and that's what I just wanted to give a real life, illustration of the impact of not doing that. And that's all from me, and I think we're back to Andy on the slide deck.
Yeah.
Yeah, thank you both. So yeah, what we've covered so far is is using protection to cover the IHT liability on the residual estate. So namely that which is left when the clients die. There are of course some scenarios in which IHT arises during a person's or an IHT liability arises during a person's lifetime, which I just want to spend a couple of minutes running through, because they are important to keep in mind as well, that there are protection solutions available for those. So lifetime gifts, for example, so a gift made during a person's lifetime to another person is going to give rise to an IHT liability for 7 years. It'll be considered a potentially exempt transfer. If the donor survives for 7 years, then it will be IHT free. But during that 7-year period, there will be an IHT liability. And I think it's fairly well known how that works, but it will taper down after year 3. So for the first 3 years, the IHT liability is 100%, i.e. 40% of the value of the gift over the donor's available nil rate band. And then after year 3, between years 3 and 7, it will taper down by 20% per year. Now, we have what we call a gift into vivos policy, which is simply a structure of five level term policies, each for 20% of the initial IHT liability, and they are for terms for 3, 4, 5, 6, and 7 year terms. And what that does is mirror the reducing IHT liability over that 7-year period. So in the table there, the example is a gift of £500,000, namely £175,000 over the nil rate band, 40% of which will be £70,000. So you divide that by 5, and that's your sum assured for each of the policies. And each of the policies will be 3, 4, 5, 6, and 7 year terms. And that will mean that for the first 3 years, the total amount of cover in place is £70,000, matching the IHT liability. And then after year 3, so years 4, 5, 6, and 7, each of those, or one of those policies, will fall away per year, reducing the IHT, the amount of cover, by 20% per year, which again mirrors the reducing IHT liability. It is possible as well to put in place an additional 7-year level term policy to cover the temporary use of the nil rate band. So as well as any potential IHT payable if the donor dies within 7 years of making a gift over the available nil rate band, regardless, there will also be the liability in the sense that the nil rate band will be used up for 7 years by the value of the gift, and therefore you can put in place as well a policy to cover the temporary loss of the nil rate band up to a maximum of £130,000, which is the 325,000, namely the maximum nil rate band a person can have, times by 40%. Might be lower than that if the gift was under the nil rate, the donor's available nil rate band, in which case a gift into vivos policy wouldn't be necessary, but you could still put in place the 7-year cover equal to 40% of the value of the gift to cover that temporary loss of the nil rate band. And where it can really work from an intergenerational sort of planning perspective as well is that the cover taken out on a joint life second death term policy. So as I mentioned earlier, the intention generally with a term policy would be when the intention is to make gifts during a person's lifetime to erode their IHT liability. And therefore we include this gift into vivos option with joint life second death term policies, which means as and when one of the lives assured was to make a gift, and need gift into vivos cover, to save them having to go back through underwriting. And of course their health may have changed. Phil alluded to it a moment ago, is, if you're planning to put cover in place at a future date, you're taking the risk that nothing is going to go wrong with the clients. Best case scenario, it's going to be more expensive because they'll be older. Worst case scenario is they're uninsurable, and then there's scenarios in between. So what this does is give that future guaranteed insurability by allowing them to carve out a gift into vivos policy from their joint life second death policy. And then the second death term policy the value of that will reduce by the amount of the gift into vivos carved out. And that can be used as many times as possible. So it is really a product that's designed to match the client's financial objectives over time. And then the other thing I wanted to, or the next thing I wanted to cover off is investment IHT, as I call it. So this is business relief qualifying investment schemes. So this is harking back to what we were talking about earlier with business relief. There are investment schemes available that some of you may well use for your clients, into which a client's money can be pooled with that of other people in order to invest in a portfolio of assets which will qualify for business relief. Now, as I mentioned earlier, business relief kicks in after 2 years. So any money invested into one of those schemes will, after 2 years, be free of IHT. But for that 2-year period, the full value of it will be liable to IHT, and therefore you need cover to be able to ensure that for that 2-year period. It's only 2 years, therefore, of course, it will be quite cost effective but crucial that, you know, if you're belt and bracing the advice of putting somebody into one of those schemes for IHT purposes, you've got to make sure you're covering that 2-year period. I'm aware there are some of those business relief qualifying investment schemes will have the 2-year period, 2-year cover bundled in with it. But of course, it's important wherever you're looking at a bundled product to compare it against standalone cover. And what you will often find is that the value of the standalone cover, whilst there might be slightly more underwriting involved than there would be with the bundle cover, the standalone cover can often be much cheaper, which on larger investments can make quite a significant difference. And then the last thing for me to cover off is just to keep in mind that it's possible to provide a very tax efficient legacy gift using protection and a whole of life in particular. So keep in mind that the premiums on a whole of life policy or any protection policy, but on a whole of life policy will generally be exempt transfers, provided they meet those 3 criteria that you can see there, that they are paid out of a donor's net income, that they form a normal spending pattern, and they don't compromise their standard of living. Then the life insurance premiums will qualify as normal expenditure out of income, and as such those premiums will be free of IHT. And what that means is that over time the premium spent on life insurance is actually going to reduce a person's IHT liability, and therefore by the point of death, at whatever point age that may be, the IHT liability will have eroded, the sum assured will have remained level on the whole of life policy, and then there's a nice difference to make comprise a legacy gift. So for the grandchildren's a car or university education or a deposit on a house, whatever it might be. And a very topical example of that is what's coming next year. So coming full circle to the start of the presentation here is that next year surplus pensions, inherited pensions, are going to be subject to IHT. And therefore, one potential solution would be that instead of leaving that pension alone, which was obviously the conventional wisdom, or until the reform comes in, conventional wisdom, if the client doesn't need a pension, leave it alone because it's the most tax efficient way to pass wealth down. Well, it won't be now, and therefore instead a client could take an income from their pension by way of an annuity or regular drawdowns in order to fund life insurance premiums to cover the IHT liability on their whole estate. And as such, over time, the cost of those premiums will reduce their IHT liability and leave a legacy gift at the end of the day. And therefore, the open question is that a better use for the pension after 6th of April next year than just leaving it there and using half of it to pay the IHT that arises directly within itself? That is me. That is me done. So I will now pass back to Phil.
Okay, you won't be done completely, Andy, because I can see a number of questions coming in.
Okay.
So some of those will be directed to you in a minute. But just to finish things off before we get to the Q&A, when you get the slides through, there will be these are links on the slide. So to Zurich's Gift into Vivos calculator and their whole of life calculator. So those useful tools are there. They're really good to use as client-facing tools as well, I think. And then we have included a video to highlight what we've just been talking, or Andy's just been talking about with Gift into Vivos, as to how you can quote for that on the exchange to get hold of market. There was a time where there were a couple of insurers that had, I suppose, single Gift into Vivos policies. There's only one remaining after Aegon left the market. So the best way to do it is to use a multi-benefit approach, as Andy described, with 5 different covers. And that video on there shows you how to do that on the exchange. And that leads us into the Q&A, one of which relates to Gift into Vivos. So I will read that. Why not take out Gift into Vivos policies to cover the nil rate band as well? So the sum assured tapers from 395 to 339k. So I think, just to answer that one, I think Chris Siddons has asked that question. certainly along the right lines. And Andy touched on having an additional policy for the 7-year term, but you only need to cover 40% of the nil rate band, as opposed to having a policy for 325k, because the liability that the loss that you're losing is the tax that you'll be paying on the rest of the estate for the loss of the nil rate band. So I don't know if you've got anything else to add to that, Andy.
No, I think that would be right. I mean, you can certainly have it within the same policy. You know, you could have the additional 7-year cover within the gift into vivos. You know, the wider structure for the gift into vivos. But ultimately, you would want to the 3, 4, 5, 6, and 7-year policies. You know, deliberately designed to mirror the reducing liability. But you can then have the additional policy sitting alongside it to cover the temporary loss of the nil rate band.
Yeah, I think on that video that I've just mentioned, where there's a link, the way that we do it on there is just amend the 7th year or the 7-year policy, the 5th policy, to an additional 130k on top of whatever the same end result, but it means you're doing 5 covers instead of a 6th one. So if a client, there's a question from Phil Soul, if a client sells a second home and invests this money, can natural income from that portfolio count as exempt transfers for life assurance premium, i.e. out of net income? Does it have to be employed income, or does investment income count? Probably one for you, Andy, as well.
It probably is. I'm trying to think of I mean, broadly, anything taken from an investment would not qualify. But that said, if it's the intention with an investment is if one is having to sell an investment in order to fund life insurance premiums, for example, then that's not going to qualify. The intention is that it is it's regular income, it's income rather than capital. And there are some scenarios where what might appear to be income is actually treated as capital. I think it would probably need more thought, in truth. I don't want to give the wrong answer, but in theory, as long as something can meet those the 3 criteria that I mentioned a moment ago, then it would qualify as normal expenditure out of income, but provided it is treated from a tax purpose as income rather than capital. So I'm not sure I can give a definitive answer to that, with apologies. It might need running past somebody very technical. But in theory, as long as it meets those 3 criteria, then life insurance premiums would qualify.
Yeah. I just to add on that, while you were doing that, I did do a bit of Googling, and the IHT manual suggests it's okay if it's dividends. So as you said, not capital withdrawals, but dividends. But we'll check that properly before.
This question is probably directed to you, Michael, because it mentions X-Tools. Can we model into X-Tools funding the premiums from current investments? So a similar question, but or linked to the previous one. Can we model into X-Tools funding the premiums from current investments and the growth rate of the investment to cover the premium?
So yes, I'm not 100% sure how to do it, but yes. Can I share my screen again while we're there?
Go for it.
So I'll make sure I've got the correct screen. So the way X-Tools works is there's all your sources of income. That could be annuities, withdrawals from pensions, drawdowns, withdrawals from investments, dividends from investments. They all get paid into a cash account, which is like your current account in your bank. And any expenses like life assurance premiums, tax, cost of living, they all come out of the cash account, as it would in real life. So there's not an explicit way to link a premium to it, but as you can see, each investment, so I've just added an investment here, we can assign a profile, and this has assumptions from Morningstar about the asset classes and what growth rate and income they could take, and what dividends and things like that. So you can sort of work it out. So in this example, if I had £100,000 general investment account, I would know, or ISA, I would know that the income was 4,100 for my conservative growth. And that's the best way we can do it. And then instead of reinvesting it back into the portfolio, I would click no, and it would get paid into the cash account and meet those expenses of the fee from the cash account, the annual premium.
Good stuff. There's a lot of clever things you can do within Xtools. Moving on to the next question regarding IHT on pensions. With the government subsequently allowing 50% of the pension funds to be withheld to pay the IHT arising on them, is there still a need for life insurance to cover the IHT liability? Do you want to take that, Andy?
That'll be one for me. Yeah. And a very good question actually, and one that I have heard before. So just for everyone's benefit, so what we're talking about here is that a year after the reform on pensions was initially announced, or a year or so, the government subsequently announced that they would allow 50% of the value of the pension to be withheld in order to pay the IHT arising directly within itself. So the government received a lot of criticism, as I'm sure you're all aware, over the proposed reform and the likely liquidity issues that the personal reps are going to suffer as a result. So this was kind of their silver bullet, if you like, was let's allow the personal reps to instruct the pension scheme administrators to withhold 50% of the value of the pension and pay it directly to pay off the IHT. In theory, seems like a good win, and maybe the right solution in some scenarios, but keep in mind there are a number of potential drawbacks with that as well. So the first one being, as I say, it can only be used to pay the IHT within the pension itself, because it will be paid directly from the scheme administrator to HMRC. So it can't be used to cover the rest of the estate liability, if indeed there is one. It will also assume, and not to be too cynical here, but it will assume the pension scheme administrators have all got the processes put in place properly by the 6th of April next year, and will be able to, not only the process in place, but they will actually be able to pay the IHT within the pensions without any undue delay, because keep in mind that 6-month limit will always be there. That doesn't it doesn't change that. And then the final thing is that, again, coming back to the 6-month deadline, is how liquid are the assets within the pension? Because, you know, if it's a SIP, for example, and it's holding commercial property or unquoted shares, well, they can take months, if not years, to sell. And therefore, you know, if a significant amount of the pension is invested in those, there won't be the liquid cash in order to pay the IHT in the first place within the 6 months. And that 6-month clock will still keep ticking, and late payment interest will keep being charged. Which brings me back to the point I made a minute ago, again, on the legacy gift slide, which is, you know, is it a better solution, instead of using the pension to pay the IHT within itself, is to use an income from said pension in order to fund a whole of life policy, and that gets away from the liquidity issue, because you know you haven't got to worry about selling the assets and how long will it take to do. So it gets around the liquidity issues, and therefore reduces the risk of late payment interest. And again, we come back to the point about the premiums being exempt and a legacy gift at the end of the day. So I would argue, sorry, it's a fairly long answer, but I would argue that yes, the need does remain, despite that. Would have been the very short answer.
Good stuff. Thank you. I'm going to direct this one to you, Michael, because we were discussing this the other day. How does the IHT apportionment apply on APR/BPR assets?
Okay, so I think Andy touched on this briefly in his slide. The APR and BPR assets count towards the residential nil rate band taper. So, you know, if that takes you over 2 million, it will count. But when you're deciding, when they're calculating how much IHT is attributable to the pension or the property or the other assets, it's only the bit above the BPR threshold. So you might have a £6 million property, but when you're working out the apportionment, how much is attributable to that property, it only counts as 1 million in the calculation of where the IHT is due from.
Okay, thank you. The last question we've currently got is in relation to underwriting, and if you've got a scenario where a client is uninsured, or one of the couple is uninsurable for a joint life, second death, whole of life policy. So you've got one healthy individual and one unhealthy individual. is that an automatic decline, or is there a way around it? That's for you, Andy.
Yeah, so just sorry, Phil. So that's joint life, second death, and one of the lives is uninsurable.
Yes.
Was it? Yeah. Okay. Yeah, and yes, absolutely, it is possible. So we see that, unfortunately, more often than you would hope. Obviously, when it comes to IHT planning, we're generally talking about older people, and older people, unfortunately, are more likely to have had something wrong with them. So it is, relatively speaking, common, something we do see quite often. So in that scenario, we can still offer joint life, second death cover, but so with both lives on the policy, but one of the lives declined. And the way that will work is it's done automated. It's automated by our system, actually. If one of the lives is declined, then the system will automatically rebase the premium on the insurable life. So effectively, it's on single life rates. It's the amount of cover, the premium that would be if it was a single life policy, but with both lives still on the policy. So it will still pay out on the second death, namely at the right time when the cover is required to meet the IHT liability, but priced upon the single life. And that's automated via the system. So it'll do that automatically.
And I think I'm correct in saying that not every provider takes the same approach on that, but Zurich obviously take that approach, and I know of one or two others that do as well. So there's no other questions, and it's kind of perfect timing because we are approaching the end of our slot. That slide there has some QR codes to be able to contact either Iris or Zurich if you've got any questions, or you want to speak with any of us in more detail. Other than that, it's just to say thank you for your attendance. Thanks to the PFS for having us, and hopefully we got through without too many technical hiccups of sharing wrong screens like I did. So yeah, thank you very much for your time.
Thanks, everyone.
Thank you. Bye-bye.